Okay. So today we will take up method of costing. Okay, I've selected few sums from the workbook that we will discuss and giving you an idea of how to approach different sums in methods. So first here is operating costing. We'll start with operating costing. So under operating costing, you need to know two terms, which is the most important terms, that is absolute and commercial method. Okay, what is the absolute? You will be given questions where you will be asked to calculate what is the absolute measurement and what is the commercial measurement. So there are two ways in which we can calculate. One is absolute and one is commercial method. Under absolute method, it is also called as the weighted average method. So weighted average method, we have to multiply the kilometer into empty quantities in case of a transport of goods. It is kilometer into quantity 1 plus kilometer 2 into quantity 2, kilometer 3 into quantity 3. So in case the goods are moving from point A to point B and then B to C and C to A, we need to see what is the distance between A to B, B to C, C to A, and what is the quantity that was carried during this 80 kilometers, 120 kilometers and 160 kilometers. So the equation will be kilometer into quantity for each segment, and add all the kilometer into quantity for each segment, you will get the total empty kilometers. In case of commercial method, it is simple average method. So what is the equation? Equation is average empty into total kilometer. Okay. So in case of the average, so again the question will be which one should I take as average, which one should I take as total. So when you consider a particular segment of operation, there is this primary factor of measurement and there is a secondary factor of measurement. So in case of transportation, the primary factor of measurement is kilometers. The secondary factor will be the quantum of goods that is carried or the number of passengers. The most important factor is your kilometers traveled. Okay. So if you are asked to calculate the what is the empty kilometers or what is the quantum as per commercial method, then you need to take total of kilometers into average quantity. So that means the total of the primary factor into average of the secondary factor. So the primary factor here is kilometers. So total of the primary factor, that is total kilometers, into average of the secondary factor, which is the quantum of goods. Okay, so average is 48 and here I have taken 48 by 3. So the average is 16 empty. And what is the total kilometer? Total is 80 plus 120 plus 160. So the empty kilometers as per commercial method, it will be 16 into 360. Okay, these two methods are very important because it can come as a 2-mark question in your MCQs. It can also be part of your total operating cost computation where you will be asked to calculate under either of these methods, absolute or commercial method, and then you can calculate what is the operating cost. Now we'll go to the next question on operating costing. Sanjeev is evaluating 3 alternative proposals for providing conveyance facility to its sales personnel who needs to travel 50,000 kilometers annually. Okay, so whenever you are attempting any question in costing, ensure you note down the points. As you read the question, you make a small note of the important points that will be useful when you start answering. Purchase and the first option is to purchase and maintain a fleet of cars. The average cost is 4 lakh. The second one, reimburse the personal cars usage at 3.5 rupees per kilometer and covering the insurance cost. Third one, hire cars from an agency at 90,000 per year. So there are three options given. One is to purchase a car. One is to allow the employees use their own car and reimburse the expenses. Third one, hire a car. Okay, so we need to calculate the operating cost for these three different options. Additional details. Petrol is 1 per kilometer, repairs, tire, insurance, taxes, life of the car. Life of the car is 5 years with an annual mileage of 50,000 kilometers. Resale value is 50,000 at the end of 5th year. Okay, so first we are going to go for option 1, purchase. When we are purchasing, the car cost is 4 lakh rupees and the residual value is 50,000. So what is the net cost? Net cost is 3 lakh 50,000 rupees. Okay, and one car, what is the annual mileage of the car? One car, the annual mileage is 50,000 rupees, which is same as the requirement for 1 year for the salesman to travel. So one car is enough. So we need to purchase only one car. So I have identified first option, purchase. The car cost is 4 lakh. Life is 5 years. Mileage is 50,000 per year. So the number of car required is 1. Okay. And what is the net value? Net value of the car is 4 lakh minus 50,000, 3 lakh 50,000. The life of the car is for 5 years. So what will be our depreciation every year? 3,50,000 by 5, which is 70,000 depreciation. So we have calculated the depreciation amount. So I've filled up the depreciation amount. Then that is the first point. Then what are the operating expenses? So there is running and maintenance expenses and there are fixed expenses when it comes to operating costing. So depreciation is one such fixed expense. It is going to be fixed. We are purchasing the car. Every year we need to charge depreciation, which is like a fixed expense. Now, running and maintenance. For running of the car, we need petrol. It is 1 per kilometer. How many kilometers are being traveled? 50,000 kilometers. So 1 into 50,000. Petrol is 50,000. Okay, so we are noting that also. Second point, repairs and maintenance 0.5 per kilometer. So 0.5 into 50,000. Tire 0.15 per kilometer. So 0.15 into 50,000. Insurance is 2,000 rupees per annum. So it is a fixed expense. We need not multiply it with the kilometers. Taxes 1,500 per annum. So 1,500 and insurance is 2,000. Okay, repairs, you can see here I have multiplied 0.5 into 50,000, tire 0.15 into 50,000. Okay, so with this we get all the expenses. And you can calculate the total cost is 1,56,000. So point to remember here, what are the points that we might forget? We might forget this depreciation component, because the depreciation component is not given in the expense list. So when you are going sitting in the exam hall, you will read the question, you will note down these points, fill up these points, you will forget the last line. The life of the car is 5 years. Why have they given the life of the car and the resale value? For you to calculate the depreciation amount. So that is one point that might generally get left off. Second place where you can have a mistake is with respect to insurance and taxes. When you're reading everything, the first 3 points, it is per kilometer. There is a good possibility you will not read the second half of this question. That is, insurance is equal to 2,000 per annum. So if you just take it as insurance 2,000 rupees per kilometer, you will end up multiplying it with 50,000. So insurance and taxes, it should always strike your mind that they are fixed cost. It is not based on the kilometers. It is based on per annum on time basis. So it will be per annum or if it might be per month. You need to check what is the criteria given with respect to fixed expenses. Then we come to option 2. Option 2 is reimbursement. So they are reimbursing 3.5 per kilometer covering insurance cost. So they are reimbursing expenses. Allow the executors to use the car reimbursing expenses at 3.5 per kilometer covering insurance cost. So 3.5 into 50,000 kilometers. There is no other expenses incurred by the company. Company is not going to incur any expenses. They are going to reimburse all the expenses along with the insurance cost to the employee directly. So it is 3.5 into 50,000. Nothing else should be accounted here. There is no purchase of cars, so no need of depreciation. The cars are not owned by them, so they need not pay the insurance. They need not pay the taxes. The entire thing is only reimbursement. Third one, hire cars from an agency. Rent cars at 90,000 per year with company covering the cost of petrol and taxes. So you are renting 90,000. So the additional expenses, rental expenses 90,000 per year. Petrol, the company is covering. So petrol expenses will be added. Petrol 1 kilometer into 50,000 and then tire 0.5 kilometer into 50,000. Taxes is also covered. So tax is 1,500. Hire 90,000, petrol 50,000 and taxes 1,500. Okay. Tire also they have not specifically mentioned. They have mentioned only petrol and taxes. So we will take only petrol and taxes. Petrol, taxes and rent. Because it is on hire, if there is any repairs or any change in the tire, it will be handled by the agency. The company need not bear the cost. That is why they are paying a rent of 90,000. Okay, so higher 90,000, petrol is 50,000 and taxes 1,500 fixed. So we are taking the expenses. Now, if you see the expenses least in case of rental, the second one in case of purchase, and the third is reimbursement. So this is the analysis that we need to provide. Calculate the cost of 3 proposals and rank them. Then process costing. So under process costing, you will have 2, 3 processes. So the output of one process becomes the input of the other process. So when you are calculating the output of one process, you will have to arrive at what is the rate at which it gets transferred to the next process. So the main point in process costing is calculation of that rate. If you are not factoring the cost properly, you will get a wrong rate. If you get the wrong rate will get carried forward. The entire answer gets completely wrong. Okay. So how to calculate that cost per unit? That is what we will be seeing in a very simple example. Three joint products are obtained by processing chemicals through 2 sequential processes. The output of process 1 is transferred to process 2. And at the end of process 2, 3 products are produced. Okay. So we need to open a process account. So here I have opened process 1, process 2 in just one single ledger itself. I put 2 different columns. You can do like that, or you can open 2 different tables or 2 different ledgers for process 1 and process 2 separately. It is as per your convenience. This saves time. Okay, if you just do it in one single go, it saves time. But you might get confused in between the particulars. So if you are not very confident, it's better to have 2 different process account, process 1 account and below that process 2 account. So first, direct material 12,000 units. So process 1, 2,000 kilograms at 6 per unit. So here I have factored in that. Direct material 2000 units, 12,000 rupees. Direct labor 5,500. Overheads 7,000. Okay. So all my cost I have debited. So debit is always the cost. Credit is the output. It is the same in every case. Even in process costing, in contract costing, debit is what comes in. The inputs, the raw material, depreciation, labor. So everything that is inputted that goes into the production is on the debit side. Everything that goes out of the production, that is your output, scrap sale, that will come on the credit side. So material, labor, overheads on the debit side. Now, there's a normal loss of 10% of input. This is where the rate difference comes. If you don't know how to treat normal loss and abnormal loss. Okay. So normal loss is 10% of input. My input is 2000 rupees. So 10% of input is 200 rupees. 200 rupees is my normal loss. So I'm putting 200 on the credit side. Anything that goes out, scrap, loss, output, everything will come on the credit. So normal loss 200 rupees. Okay. Now normal loss, if there is no sale of that loss, if it's a scrap and it cannot be sold, there is no value for it, we'll park it as 0. So 200 units will be 0 value. If there is some scrap value, then whatever is the scrap value, whatever is the realizable value, that we will mention. So here it is mentioned scrap value of loss is 3 rupees. So 200 units at 3 rupees, which is 600. So I'll get 600 rupees from this normal loss of 200 units. Okay. So my total input is 2000. Normal loss is 200. So my normal output should be 1800 units. Okay. But the output, actual output is 1900 units. That means there is an abnormal gain. The same thing will happen in case of abnormal loss also. Abnormal gain and loss. So in process costing, whenever there is a movement from one process to another, we need to calculate what is the normal loss, what is the abnormal gain or loss. So how to calculate abnormal gain or loss? Material inputted minus the normal loss, which should be the normal output. That should be the output that we should get. So if we have got a different output, if the actual output is different from the normal output, that is either the abnormal gain or abnormal loss. So in this case, there is an abnormal gain of 100 units. Okay. Now, what is the rate at which this abnormal gain should be recognized? Okay. The rate at which the abnormal gain should be recognized is, you can see here, the total cost minus the scrap value of normal loss. If there is any scrap value for the normal loss, you reduce that also. That will be your net cost. If there is no scrap value for the normal loss, it will be 0. The total cost itself we will be taking. Okay. So you can just say, remember, total cost minus scrap value of normal loss. That is the net cost. Net cost by your normal output, not the actual output, normal output. Net cost by normal output. That will be the rate of abnormal gain or abnormal loss. Okay. Net cost by normal output. So we got that the rate of abnormal gain is 14.015. So 100 into 14.015 has to be factored in. Now which side will we enter this? Either on the debit side or on the credit side. Because here we have 1900 and we have 200. So how much is it here? 2100. That means I need to factor the abnormal gain on the debit side. Then only I will get 2100 on both the sides. Right? It is a gain. It is over and above the loss. So loss I'm putting on the credit side. So gain I'll have to put it on the debit side. So abnormal gain 100 and the rate is, we have calculated the rate multiplied in by the uh, amount. That will give us the abnormal gain. 13.28. So that is what I've taken here. Abnormal gain 100 into 13.28. Okay. So total cost we have to take before this gain. Total cost 24,500 minus 600. So we have calculated the rate of abnormal gain. Now what is the output? Output is 1900 units. So what is the rate of output? Same as that of the abnormal gain. So we have calculated what is the per unit cost here. Okay, the same rate we can use 13.28. So 13.28 if you use, or you can take the balancing figure also. What is the total cost? Total cost minus your normal loss scrap value. The balancing figure will be the abnormal, the balancing figure will be your carry forward to process 2. Okay. So this 25228, which is the credit or the output in process 1, will become the debit or input in process 2. Okay. Credit in process 1, it is coming out, and then it goes as a debit as an input in process 2. So in process 2, we will have the process 1's output as the input, which is 1900 units as 25,228, the rate that we have calculated. You can multiply it with the same rate, the rate into the units, you will get the same answer, or you can just take the balancing figure and that also you'll get the same answer. So one way to cross verify that your answer is correct is take the balancing figure and then just multiply the units into rate. See if it is coming as equal to the balancing figure. If it is coming as equal to the balancing figure, that means your answer is correct. So then process 2, we have taken what is the input of process 1, and then direct labor 6,500, overheads 5,400. Okay, added these two things, we'll get the total cost. Is there any scrap? There are no scrap. There's no scrap. So the entire quantity comes out as an output. The output is in the ratio of 3:3:4. So the 1900 units have to be divided into 3:3:4. So that is 1900 into 3 by 10, 1900 into 3 by 10, and 1900 into 4 by 10. We get the output. Output should be on the credit side. And then balance it. Ideally, your account should get balanced. If the account is not getting balanced, that means there is some mistake done. Okay. So now you have got the output. Process costing is done. You have identified what is the output of process 1. You have identified the abnormal gain and what is the rate of abnormal gain, the rate of output also, and then accordingly calculated. So here in the output in process 2, it is mentioned that it should be in the ratio of 3:3:4. So the cost is also divided in the same ratio as that of quantity, 3:3:4. Okay. Now, sale price is given 25 per kg, 20 per kg, and 12 per kg. You are asked to calculate what is the cost, what is the profit. Calculate the profit for joint cost product by allocating the total cost from the process based on the weight of output and the market value of production. So right now what I have done, I have divided it based on the weight of output, which is 3:3:4. The total cost of 37,218 is being divided in the ratio of 3:3:4. Okay. And we know what is the price of the product. It is given in the question. It is 25, 20, and 12. Okay, 25, 20, and 12. This is the sale price. So what will be the total sale value? 570 units into 25, 570 into 20, and 570 into 760 into 12. profit or loss, total sale minus the cost. Okay, so there is profit in two segments, two products, and there is loss in one. This is based on quantity. When the cost is divided in the ratio of the quantity or output, weight of output. This is what we did now. Now the question doesn't stop here. Okay, it asks you to calculate what is the process cost. Okay, calculate what the gain and then arrive at the output in the second process. And then at that point, based on the weight of output, you calculate what is the profit, profit or loss. The second part of the question is based on the market value of production. So the cost, the total cost of 37,128, if you are dividing it based on the market value of production between PQ and R, then what is the profit or loss? Okay. So profit calculation I have put in case 1 and case 2 here. Case 1 is as per our quantity that we have calculated. Okay, this is what we saw now. What is the sale value and what is the cost of production? Cost of production I have divided based on the quantity only. Second case is profit calculation based on the market value. So the sale value we have identified, it is going to be the same 570 into 25 and then into 20 and 760 into 12. So if the cost is divided in proportion of the market value, what is market value? Market value means sale value. So based on the sales, if we are dividing the cost, then what is the profit and loss? So the total sale is sum of these through 34,770. So the cost of 37,128, which is the total cost, instead of dividing it based on the ratio of 3:3:4 quantity ratio, we have to divide the total cost of 37,128 in ratio of the market sale or the sale value, market proportion meaning sale value. So 14,250 by 34,770 into 37,128. So you are just dividing the total cost of process 2, that is the process 1's output getting into process 2 plus the cost of process 2. The total cost is being divided in the ratio of the sale proportion. Then you will get the different profit or loss. Then the profit or loss will be different. So they have asked you to calculate the profit and loss by dividing the total cost based on the quantity or the proportion that is given in the question, and second scenario based on the sales turnover. So here in this question, where you can go wrong is 1 point, calculating abnormal loss, abnormal gain, sorry. So most of the time we will leave out the abnormal gain. Normal loss we will factor in and then we will take the balancing figure. We'll put this 3 parts, material, labor and overhead. We'll put the normal loss and then we will just take the balancing figure, take it to the next product. That is one area where we go wrong. We need to calculate the abnormal gain or loss in every process cost question. You have to check if there is a possibility of abnormal loss or gain and then only carry forward. Okay, so that is one point where you can go wrong. The second place where you can go wrong is not understanding the question. You will identify process cost. You will divide it based on 3:3:4. You will get the cost. Then you will calculate the profit also, because you will read this part here. Calculate profit based on the by allocating the cost. So okay, I'll have to calculate the cost just like how I've done it here. You will take the total process cost divided and then the sale value and then arrive at the profit or loss. The second part, that is the market value of production, this you might leave out. And there will also be a doubt on what does market value of production mean, right? Because they have not given a very straightforward question. Calculate profit based on the weight of output and based on sales turnover. If they use the word sales turnover, it is much more easier for us to understand. But when they use the term market value of production, then you will get confused as to what is market value of production. How should I arrive at market value of production? Okay, so understanding the question, understanding what they are asking is also very important. And read the question completely so that you don't miss out on any of the parts. So next we will do a question on joint product, very simple question. So from this question, we can understand 70% is main product, 20% is byproduct. Okay, total units is 5,000 units. So 5,000 into 70% is your main product, and 5,000 into 20% is the byproduct. What happens to the balance? The balance is your normal loss. 500 units is normal loss. Normal loss is always considered with the main product. Okay, when you calculate what is the cost of byproduct, you need not consider normal loss. Now, material cost. Material 5,000. 5,000 units. What is the cost? 27 rupees. Okay. So what is the cost? The question is to determine the cost of byproduct. Only the byproduct. They have not asked us to calculate the main product at all. So 5,000 into 27 into 20% is the byproducts material. Additional charges is 15,000, out of which 30,000 is power. So additional charges 15,000. Out of 15,000, 30% is power. So 4,500 rupees amounts to power. And power is allocated in the ratio 1:5. Okay, so 4,000 out of 4,500 rupees, 5/6 is relating to the byproduct, because it is 1:5. 1 is main products component, 5 is the byproducts component. So 4,500 into 5/6 is the cost pertaining to the byproduct. Then what is the balance? Balance amount is 10,500. That is 15,000 minus 4,500 gives us 10,500, or 70% of 15,000 gives us 10,500. Okay. So this 10,500, how we will allocate? Because no other method of allocation is given. So we can allocate based on the quantity. Quantity is 1,000 by 4,500, because 500 is normal loss. 1,000 by 4,500. We'll get the total cost. So here again, points to remember: how should the other cost be determined? Other cost, if nothing is mentioned in the question, you have to take the quantity as the basis for dividing cost. If there is a measurement given, like in case of power, it is given that it is 1:5 is the ratio of uh, uh, the consumption of power, then you have to use the ratio. That is one point to remember with respect to joint cost allocation. Joint cost allocation can be done on certain equitable basis. What is the equitable basis of allocation? It depends upon the data that is given in the question. If there is nothing specified in the question, you can take quantity as the measure to divide your cost. We'll continue. Next, we'll go to contract costing. Contract costing, there is a question from contract costing in every attempt. So you need to be thorough with contract costing. So under contract costing, you will be asked to prepare the contract account. Contract account debit side is all your inputs into the contract, and the credit side will be the output. It will be the work certified, work uncertified, and closing stock. If any material is returned, the return value of material. So this will be on the credit side. So here this question, we have two contracts, contract M and N. Okay. So we are asked to prepare the contract account and also the extract from balance sheet as at 31st December, showing the work in progress calculation. So you'll get questions like this only in contract costing. Material. So I'm taking the details from the question. Material 1,20,000 and 50,000. Material return to store will be on the credit side 40,000 and 10,000. Material at as at site on 31st December. So closing stock again on the credit side 22,000 and 8,000. Direct material payment 1,40,35,000 will be on the debit side as labor. Direct expenses 50,000, 20,000 on the debit side. Architect fee 5,000, 4,000 on the debit. Establishment charges 32,000, 14,000 again on the debit side. Plant installed at cost 80 and 70. Value of plant as on 31st December 65, 64. That means the difference between your opening value and closing value of plant is the amount of depreciation that is charged. So 80 minus 65 is the depreciation amount. 70 minus 64 is the depreciation amount, which is 15,000 and 6,000. Accrued wages 10,000 and 5,000. Accrued wages means wages due, not yet paid. Accrued wages, accrued expenses also should form part of your contract costing because we are trying to find out what is the profit. Profit is based on accrual system of accounting and not cash basis. So we need to add these expenses also. Accrued wages as on 31st December and accrued expenses as on 31st December. So with this, once we add all the expenses, you will get the total cost. So material, okay, labor, direct expenses, any architect fee, establishment charges, depreciation, any accruals. So if you add that and reduce return of material, closing stock, we will get the cost of construction. Okay, there is one adjustment over here. We will see that adjustment also. During the period, material amounting 9,000 has been transferred from contract M to N. So during the period, 9,000 rupees worth material was moved from contract M to contract N. So it was an input in N and it was an output in M. That is what I have marked it here. It is an output in M account and it is an input in N account. Okay. So with this adjustment, we arrive at the total cost of construction, which is the balancing figure. 3,78,000 minus the credit amounts. The balancing figure will be your cost of construction. Now the cost of construction needs to be divided into work certified, work uncertified, and then you have to arrive at the profit. Work uncertified is always shown at cost. Work certified has a profit element involved. Now the entire profit element, we cannot take it to P&L. Certain amount, because the work is not yet completed, right? The construction is not yet completed. So you cannot recognize 100% as profit. So in the work certified, there is a profit element, and in that profit element, a certain proportion should be kept as reserve and certain proportion should be recognized as profit. So cost of construction, I have brought it forward. Okay, this is the cost of construction on the credit side. I'm just bringing the cost of construction down in order to divide it into work certified, work uncertified, profit element, and the reserve element. So total cost of construction for the contract N is contract M is 3,07,000 and N is 1,32,000. Okay. Now we need to calculate what is the value of work certified and work uncertified. We'll come back to the question. The cost of contract not yet certified 23 and 10. It is given in the question. The cost of work uncertified is given in the question. Okay. So WIP uncertified is 23,000 and 10,000 as given in the question. What is the work certified? Cash received from contractor is 3,78,000 and 1,25,000. Cost of contract not yet certified. The value of contract certified is 4,20,000 and 1,35,000. So the work certified cost is also the value of work certified. So there is a difference. You have to note cost of work uncertified and value of work certified. Okay. So the value of work certified is 4,20,000 and 1,35,000. Why it is mentioned as value? Because it includes the profit element also. So once you balance this, the difference between cost of construction and the value of work certified, cost of work uncertified will give us the profit element. The profit element involved in this work certified. Because this is also cost, this is also cost. So what is the only thing that is value? Value of work certified. Okay. So the notional profit that is involved in the work certified, that is the balancing figure, which is 1,36,000 and 13,000. Okay, now we will bring down the notional profit. So why I'm taking each of the steps separately is that it will allow us not to have confusion. It will ensure that the calculations are proper. If you want, you can calculate, put work certified here, work uncertified here, and calculate the notional profit, divide it in this contract account. In this first step itself, you can finish everything. But there is a possibility of errors. So I would suggest you calculate cost of construction as the balancing figure and then bring it down. Then go to the second part. So this part 1 is calculating the cost of construction. Part 2 is dividing the cost of construction between work certified, work uncertified, calculating the notional profit. And the step 3 is identification of the profit to be transferred to P&L and transferred to reserve. So if you divide the contract account into 3 steps, it will ensure that you don't make mistake. Step 1. Okay. Step 2 is calculating your notional profit. So step 1 is cost of construction. Step 2 is calculating the notional profit. And step 3 is calculating the amount to be transferred to reserve and to P&L. Okay. So once you calculate, arrive at the notional profit. Now the notional profit, there is different formulas available based on the percentage of completion. Based on the completion of percentage completion, either 1/3 or 2/3 and of the profit need to be transferred to reserve and the balance to the P&L account. So here we need to see what is the percentage of completion. Percentage of completion, the value of what is the work certified? It is 4,20,000. What is the total value of the contract? 6 lakhs. So 420 by 6. 4,20,000 by 6 lakhs, 70% completion. What about the second one? The value of work certified is 1,35,000. Total value of contract is 5 lakh. So 1,35,000 by 5 lakh. It is 27% completion. Okay. So that means in one case, 1/3 of the profit and the other case, 2/3 of the profits needs to be transferred to reserve and to P&L and the balance to the reserve. Okay. So this formula, I'm not going deep into the formula. You will have to, memorize these formulas. Notional profit into 2/3 into cash received by work certified. And in this case, again, 1/3 into notional profit into cash received by work certified. The balance amount will be the reserve. Okay. Once you calculate the amount to be transferred to P&L, the remaining amount balancing figure will be the amount to be transferred to reserve. Okay, so contract costing ensure 3 steps in the contract account. One is calculating cost of construction. Second one is your notional profit calculation. Third one is application of formula and identifying the amount to be transferred to P&L account, and the balancing figure is the amount to be transferred to reserve. Okay. Now, the second part of the question, it requires us to calculate and show how it is to be presented in the balance sheet. So WIP, we know the value of work certified is 4,20,000, value of cost of work uncertified is 23,000. In the second question, the value of The value of the contract certified is 1,35,000. Cost of the contract uncertified is 10,000. So those two parts you will have to bring it on the asset side. WIP certified, WIP uncertified. You will get the total. So in this, what is the amount should be reduced? Reserve amount, the amount that is to be carried forward to reserve, that has to be reduced, and the any cash received should be reduced. The balance will be staying as the on the asset side as a receivable. This amount is yet to be received from the client. So value of work certified, cost of work uncertified will give us the total value as on now, and in that any reserve, the amount that is to be carried forward to reserve, we have to reduce it. Cash received needs to be reduced. The net balance will be the balance receivable from the client. And on the credit side, the profit that is recognized, profit and loss that is recognized on both the contracts will be shown on the credit side under profit and loss. Okay, this is how it will appear in the balance sheet. This is also very important. You will be asked a question. If you are asked a question on contract costing, you will be asked to show how it appears, how the work certified and work uncertified appears in the balance sheet. Okay, so next we'll go to batch costing. So under batch costing, this question we've already discussed. We'll just again discuss that. So under batch costing, you need to know how to calculate EBQ, that is economic batch quantity. That is very important, the equation to calculate this economic batch quantity. And you will be asked a question giving different batch sizes, and then you will be asked to calculate what is the cost at different batch sizes. For example, in this question, Ashi Private Limited assembles electronic units for a customer who requires an equal number of various unit types amounting to 45,000 annually. The annual quantity requirement is 45,000. The customer stipulates that the batch sizes for any type must be at least 1,000 units, and it should be in multiples of 500. So 500, 1,000, 1,500, 2,000, like that, multiples of 500 only we need to have batch sizes. The customer is willing to accept the entire production of a unit as soon as the batch is completed and does not require any specific timing for delivery. The assembling of the machine requires a setup. So setup cost is 50 rupees. Setup cost I have noted down here. It is 50 per batch. Carrying cost is 20 rupees. There is 20 rupees of variable cost, and the interest on the element, that is on the capital, is 20%. So carrying cost is 20 rupees into 20%. That is 4 rupees. So first, when you get batch costing, note down the quantity details, note down the setup cost, carrying cost, because that forms the crux of batch costing. Then, so under different levels, we have 500,000, 1,500, 2,000. So if I have to run a batch of 500, I am running 500 unit batches. How many batches will I have to run in order to arrive at 45,000 units? So it is 45,000 by 500. So I have to run 4,500 batches. So what will be the setup cost for each batch? 50 rupees. So 4,500 in, 450 batches. 450 batches into 50. 45,000 by 500. So I have to run 90 batches. Sorry, I have to run 90 batches. So if I have manufacturing at 500 units in one batch, I have to run 90 batches to ensure I reach 45,000 units. So per batch is 50 rupees. So 90 into 50, 4,500 will be my setup cost. What is the carrying cost? Carrying cost is average inventory into carrying cost. That is the total carrying cost. Average inventory is 500 by 2, 1,000 by 2, 1,500 by 2. Because across the year, we are going to have an average inventory of 750, average inventory of 500. Okay, so by 2, you have to do in order to calculate the average inventory. So the batch size by 2 will give you the average inventory into the carrying cost per unit. That is the total carrying cost. Now, what is the total cost? total cost of running a batch is the setup cost plus carrying cost, which is 4,500 plus 1,000, 2,250 plus 2,000. So like this, you will get a cost to be 4,250, which is the lowest. So you can say that manufacturing at 1,000 batch size is the most economical one. Okay. In the same question, you can also use EBQ formula to calculate the answer. So in case if you don't know how to use the EBQ formula or you are not able to solve it that way, you can solve it this way. If even if a question comes asking you to find out what is the economic batch quantity and you don't know how to calculate, you forgot the formula, just remember, you just have permutations or different batch sizes. Just put 500,000, 1,500, 2, 3 batch sizes and then calculate the setup cost, carrying cost. You will be able to arrive at which point you are having the lowest cost. Okay, so approximately you will be able to identify what will be the economic batch quantity. Job costing is to find out what is the cost of doing one job. Okay, so what is a step in job costing? First, you need to identify what is the cost of material that is used for the job. Then you need to identify what is the cost of labor that is used in the job. Okay, material and labor you will be able to calculate directly, because it will be given in the question. You will be able to identify directly what is the cost of material used in the job and the cost of labor used in the job. But overheads will be given at the department level. For example, in case of a small tailoring shop will have a lot of overheads like lights, heating, lighting, repairs and maintenance. All this they cannot factor in for one job. These are overheads that is charged for the entire shop. But when we take when we are trying to calculate what is the cost of one job, maybe one material, one salwar material being stitched, what is the cost? We need to factor these overheads also. Overheads. So we need to identify the overhead absorption rate and then apply that overhead absorption rate to identify the proportionate overheads. Okay, so this is the steps in job costing. You can remember the steps, you will not miss anything. First, cost of material, cost of labor, overhead rate, and then absorb the overheads based on the overhead rate. So we'll go to this question. Material 400, okay, and material Z for department B 300, material return 30, and abnormal loss 5. So net I can say it is 265. Okay. Material, we need the value of material. Material value is given, opening stock, purchases. So we need to identify what will be the rate when there are stock and purchases at different rates. You need to arrive at the weighted average rate for one unit. How to arrive at the weighted average rate? Weighted average rate is quantity into rate for each of the purchase. So 1,050 into 26. Okay, the value of opening stock is given 2648.75 plus 600 into 2.5, 500 into 2.5, 400 into 2.6 by total quantity 1,050, 600, 500, 400. Okay, rate into quantity by total quantity. It will give us the rate per unit. 2648.75 plus 600 into 2.5 plus 500 into 2.5 plus 400 into 2.6. Total quantity is 1,050, 600, 500, 400. So divide the quantity cost by quantity, you will get the rate per quantity. Okay, now rate per quantity into the quantity pertaining to this particular product, this particular job will give us the material cost for this job. Okay, we have the total quantity, total cost. So we are arriving at cost per unit. Cost per unit into 400 units used for this job. It will give us the material cost for this particular job. Labor 70 hours. Rate is 22.5. So labor is 70 into 22.5. Okay, there is an overtime of 6 hours. So you need to add that also. So 76 into 22.5. Overheads. Now, when it comes to overheads, we need to calculate what is the total overhead and then arrive at the overhead rate and apportion the overhead cost based on the overhead rate. So we come to here, if you scroll down, there is different overheads provided in the question itself. Okay, we have indirect labor, overtime premium, consumables, maintenance, and other repair works. Okay, there is also a rectification work here, hours spent on rectification work. Rectification work is an indirect cost. So it will come as overheads only. So the rectification cost will be 20 hours spent at 22 rupees per hour. So 450 rupees rectification cost also will come under our overheads. So this will give us the total overheads. Once we get the total overhead, under what basis are we going to divide? We have got the total overheads. But under what basis will we divide the overheads? We don't know how many jobs they have completed. So if they have given that 100 jobs have been completed in this month, and this is one such job, then we can divide 2600 into 1 by 100. But we are not given the details about the number of jobs completed. So what is certain, we need to have certain common base against which we can absorb the overhead. So if nothing is given in the question, you can take labor hours as the basis. Okay, because we know here the direct labor hour, labor at basic wage rate is 45,450. Okay, so 45,450 is the total wages that has been paid during the month. Okay, and we know for 1 per hour rate is 22.5. So total labor hours is 2020. Okay, out of this 2020, we know 20 hours is with respect to the rectification work. That I have already factored in as 450 rupees. So we need not take that again. Okay, so I will divide, I will reduce that also. So the net number of hours is 2000 hours. So this 26,100 overheads is for 2000 working hours during the month. So for 1 hour, it is 13.05. So each 1 hour of labor, the overheads being absorbed is 13.05. Now we got the overhead rate. Once we get the overhead rate, multiply, we know how many hours have been spent in this particular job. 70 hours have been spent in this, 70 plus 6 overtime. So 76 hours have been spent in this particular job. So 76 into the overhead rate 13.05 will give us the overheads to be absorbed for department A. Okay. Once you add material labor overhead, you will get the total cost. So job costing, the main aim for you should be to identify the cost for that particular job. If it is total material cost has been given, then you see out of the total material cost, what is the quantity consumed for this particular job and then proportionately take it. Labor, identify what is the total number of hours that is spent for this job. Out of the total cost, take the proportionate labor cost. Overheads, again calculate the total overheads divided based on certain common base. Now the common base will differ from each question. In this question, we had labor hours. There is this direct labor details were given to us. So we have divided it based on labor hours. If quantity details have been given, we can take it based on quantity, but generally we will take it based on labor hours or machine hours only. So either labor hours or machine hours. That will be your base for overhead absorption. Okay, so calculate the total labor hours or total machine hours, divide the total overheads by total labor hours, you will get per hour overhead absorption rate. Multiply it with the number of hours that is spent in this particular job. Okay, so that is the steps involved in job costing. So ensure in job costing, the idea is to find what is the cost of one job. So total cost need to be proportionately taken towards this one job. So good morning, and today we will be seeing technique of costing. So techniques of costing has three different parts. One is marginal costing, standard costing, and budgets. All three parts are very important. You will get one question each from each of the part. So this chapter alone will help you to fetch about 20 to 24 marks. Last attempt it was labor variance. So I hope with this attempt it should be a question on material variance. Okay. There's also a simple method for remembering the equations. Okay. So you can just remember SQ into SP, RSQ into SP, AQ into SP, and AQ into AP. Just remember, just number it, and then you can remember that the yield variance is 1 minus 2, mix variance is 2 minus 3, usage is 1 minus 3, price is 3 minus 4, and cost is 1 minus 4. So either you can memorize this hack method, or you can understand the equation. So in case of cost variance, it is the difference between total cost. So actual into standard minus actual into standard. In case of price variance, price only changes, quantity remains the same. So actual quantity into SP minus AP. And then there is yield variance where only the quantity changes and the price remains constant. Okay, so here first we need to find out what is the cost variance. So cost variance is SQ minus SQ into SP minus AQ into AP. So here standard quantity I've done only for material A. So standard quantity is 120 into 0.25 minus the actual one. Actual is 90 into 0.2. So we get 12, which is a favorable variance. Positive meaning favorable, minus meaning adverse. Price variance. So price variance, the actual quantity remains the same. Only the price changes. So actual quantity, I'm taking 90 units. Okay, for material A, same we need to do for material B, and we need to do the total variance also. So if you ever get a question on standard costing, there are 2 or 3 materials, you need to find out the variances for each material separately and find the total variance also. Okay, then only you will get marks for individually as well as total. If you just put material A and material B and you do not total it, you don't find the total variance, you will lose marks. You need to find the total variance also. So price variance. So price variance, there is a change in the price, that is 0.25 and 0.2 into what is the actual quantity, 90 for material A. So we get 4.5, a favorable variance. Then usage. Usage variance is SP into RSQ minus AQ. Now, the RSQ data is already given. Okay, so we can go ahead with the RSQ data that is given in the question itself, which is 80. So SP, standard price, that is 0.25 into 90 minus 80. We get minus 2.5, which is an adverse variance. Okay. So this is standard costing. Standard costing is very simple. Give more importance on the material sums this time. And be thorough and understand the logic of how a revised standard quantity is calculated. We'll see this particular question where there is the calculation of revised standard quantity. Okay. So I'll just explain revised standard quantity again. So revised standard quantity, when do we need to find out revised standard quantity? Revised standard quantity needs to be found out when the proportion in which the input is utilized is different. Okay, for example, here the input quantity is 50 kilos, but the actual input used is 30 kilos. the input quantity differs or the proportion in which they have been used is differing. Okay, here it is 1:2:2. But in the actual, it can be 2:1:1. This, it can be, the output can be same, sorry, the quantity, total quantity of the material can be the same. Okay, so example A, if I am using A and B, 10 and 20. This is the standard mix, the standard inputs that is utilized. But the actual, I have used 20 and 10. Okay. So then we have to find out what is the revised standard quantity because the mix is changing. If there is a change in the mix, we need to find out revised standard quantity. If there is a change in the input that's used, then also we need to find out revised standard quantity. That is, I've used 20 of this, 20 of this, but in the standard is 20-20. That is 50% of A and 50% of B. But actual, we have used 20%, that is 70% of A and 30% of B. So again, the mix is changing. The total inputs that are being used is also changing. Okay. So if the input quantity of input changes, you need to calculate revised standard quantity. Okay. Quantity of input changes. Changes between standard and actual. If mix of input changes between standard and actual, we need to calculate revised standard quantity. Okay. If the mix meaning the proportion, if proportion changes, but the total input of raw material remains the same, still you have to calculate revised standard quantity. If the quantity of input itself changes, you need to calculate revised standard quantity. Okay. So this you have to remember when you need to calculate revised standard quantity. Okay. Now, next one is output. I am using A and B material. Okay. I get an output of 100 units. This is my standard. Okay. I use 50 units of A, 50 units of B, and I get an output of 100. Now, I use the same 50 units of A, same 50 units of B. I get a actual output of 200. So here the output differs. Here the total input is differing. So this point is very important. Okay. So when the input quantity differs, we will calculate revised standard quantity RSQ. Okay. When the input mix differs, we will calculate revised standard quantity. When the output differs, when the quantity of output differs between standard, the standard is given for 100 quantity of output, but the actual data is given for 200 quantities of output. We need to adjust the standard quantities. What is the standard quantity for actual output? Okay, that is, we don't name it as RSQ, we name it as standard quantity for actual output. Okay, so that will be 200 by 100 into 50 for A, and for B it will be 200 into 100 by 100 into 50. So what you are doing is exactly the same. Here it is actual output by standard output into standard quantity of input. Okay. Actual output by standard output into standard quantity of input will give us the standard quantity of input for the required output. Okay. Standard quantity for actual output. Then in RSQ, what we are doing? Actual quantity of input actual total quantity of input, not the only for A, only for B. Actual total quantity of input by actual total quantity of, standard total quantity of input into standard quantity of input of material A. Here also standard quantity of input of material A. So material A and B, we need to calculate separately what is the revised standard quantity as well as what is the standard quantity of the actual output. Okay. So you need to be careful when you are solving the sum. When you get the question itself, first check for the outputs. What is the standard output? What is the actual output? Is it same? If it is same, you need not do this adjustment. This adjustment you need not do. That is gone. So we are saved from one adjustment. Then you come to the second part. Check what is the actual total quantity of input. What is the standard quantity of input? Are the totals matching? If the totals are not matching, you have to find out revised standard quantity of the input. Okay, which is called as RSQ in the formula. Then the third check that what you have to do, check the mix. A and B, what is the proportion in the standard? A and B, what or the material, what is the proportion in the actual? If the proportion is same, you need not calculate RSQ. If the proportion is different, you have to calculate RSQ for inputs. Okay. So this is the two adjustment that will come, and they are the same, but still they are different. One is adjusting your standard quantity against the output. One is adjusting the input in the proportion if the input quantity is different. Okay. So now we'll come to this question. So here you see they are silent on the output part. The following is the information, compute material variances. Simple direct question. We don't know what is the output. So I will assume that output for standard and actual is same. So my first that adjustment of standard quantity of actual output, that I need not do. Then I am coming to the second thing. I am checking what is the inputs total, input material total. There is a difference. That means I have to calculate revised standard quantity of the inputs. Okay. So standard quantity data, just plot in the details. So standard quantity data is given. Standard price data is also given. Actual quantity data is given 5, 10, 15, and the actual price is also given. Now revised standard quantity we have to calculate. What is revised standard quantity? Total actual mix, that is the total actual input by standard actual input into standard material A. Okay. So it will be here actual 30, standard 50 into 10. It is 6. Then 3 by 5 into 20. Okay. It is 30 by 50. I'm reducing it to 3 by 5. Okay. Again 3 by 5 into 20. So the revised standard quantity of the input is 6, 12, 12. Okay. Which totals to 30. And once you get the details, then calculating the ratios are very easy, because either you can use this formulas or you can use the hack method. Calculate SQ into SP, RSQ into SP, AQ into SP, AQ into AP, and then 1 minus 2, 2 minus 3, 3 minus 4, and 1 minus 4, you get all the variances. Okay, so this part is something that's very easy. Either memorize the equation or memorize the hack method. But calculating RSQ is where we always go wrong. Now we'll go to illustration 12. It's a question on marginal costing, okay, where three different scenarios are given. Currently, XYZ runs a single shift with the following associated cost and revenue. sales, direct material, direct labor, material overheads, contribution, fixed overheads, profits is given. Currently, 20,000 units are being manufactured. Now, there is an additional demand for 30,000 units at the current selling price. Okay. Running a second shift would incur an additional overhead of 40,000. However, we will get 4% bulk discount in case of material purchases. Fixed labor cost, that is direct labor cost for the second shift would remain the same as that of first shift, and there will be an additional second shift allowance of 10%. Advise the company whether they should proceed with the second shift or not. So the first step is to find out what is the profit. They have given the profit, they have given overheads, contribution and everything. So first we need to put all this in a marginal costing format, which is sale minus variable cost. A variable cost has direct material, direct labor and variable overheads. We'll get the contribution. Contribution minus fixed cost is your profit. So first you have to put this for the 30,000 or 20,000 units. Okay. And arrive at the profit of 3 lakh. Then we will see how to include the other 30,000. So I want you to solve this sum. The first part will just take 5 minutes. Note down the first part and identify in the same format. You can note down the marginal costing factors, and then we will go to the second part of the question. We have the current scenario now. Additional 30,000 units have been added. So what is the total number of units now? 50,000 units. So we have to prepare two different scenarios. One is the total with additional shift, and what is the incremental? This is total. This is for 20,000 units. This is for 30,000 units. Okay. So when it was 20,000 units, it is 12 lakhs. So 12 by 20 is 60 rupees is the sale value. So 60 into 50,000, we get 30 lakhs. So what is the incremental sale? It is 18 lakh. Difference between these two, 18 lakhs. Now direct material, they have told we will get a 4% discount. So 3 lakh is for 20,000 units. So again, we need to calculate 3 lakh is for 20,000 units. So that means it is 15 rupees per unit. Now it is 15 rupees, 96% of 15 rupees because we get 4% discount into 50,000. That is 7,20,000. Then you find out the incremental factor also. Direct labor is 4 lakh for first shift. Second shift, they have told it will increase. It is the same 4 lakhs plus an overtime allowances of 10%. Okay. So 50,000 into 20 per unit. Now 20, how am I identifying? 4 lakh by 20,000. So 4 lakh by 20,000, 20 per unit. Now for 50,000, I will need, what will be the wages? 20 into 50,000. So that is the total wages. Plus for 30,000 units, we have to give an additional 10% allowance. Okay. So that is 60,000. For the additional 30,000 units, there is 10% on the wages is the allowance. So that also we are adding. It's 10,60,000. Variable overheads. Variable overhead is 80,000. So per unit, it will be 80,000 by 20,000. Per unit is 4 rupees. Now it will be 4 into 50,000 because additional 30,000 getting added. Okay. So once we reduce sale minus variable, all the variable costs, we'll get contribution, which is 10,20,000. Fixed cost. Fixed cost, it remains the same. Fixed overhead, 1,20,000, and there is an additional overhead of 40,000. So it is 1,60,000. Once you reduce that, you get the profit. So what is the incremental profit here? 8,60,000 minus 3 lakh. So the additional quantity, the additional units of 30,000, if XYZ manufactures, he will get a increase in profit by 5,60,000. So it is recommended to go ahead with this particular project. Okay. So when you are attempting such questions, you will have to give 3 breakups. What is the current scenario? What was the additional units, that is, or the proposed increase in the sales? And what will be the total increase after this change? we'll go to the next question. There is a high demand for the product and the labor force is already operating at full capacity with no possibility of overtime. The customer has offered 32,000 for a special order, which would require 9,000 in direct material cost and 800 hours of direct labor. Advice are limited whether accepting this special order would be beneficial. So there is a high demand for the product, okay, and the labor force is it is completely utilized. So the limiting factor. So in marginal costing, there is something called as limiting factor. Limiting factor is the factor that is of limited, that is like it can be material, labor, that is a limited availability. So we need to use the limited availability input to its maximum uh, benefit. So the combination that gives us maximum contribution against the limiting factor, that is the option that we have to select. Okay. So here, what is the contribution? Okay, that is part of the question also. The sales data is given. Okay, sales data is 130. So currently a product is being manufactured which is sold at 130 per unit. Okay, direct labor material is 30 and direct labor 40. Variable overheads is 20. So 90 is our total cost. Contribution is 130 minus 90, which is 40. Okay, so 40 is the contribution per unit of something that is being manufactured now. So the current situation, you get a contribution of 40 per unit. Now, what is the limiting factor? Limiting factor is labor hours. So we need to find out what is the contribution per labor hour. The contribution per labor hour, 4, they have given in the question, 4 hours. To manufacture 1 unit, they take 4 hours. Okay, so the contribution per hour will be 10 rupees. 10 rupees is the contribution per hour. Now we have a new order which will give us a sale value of 32,000 rupees. We require an additional material of 9,000 and 800 labor hours. So labor hours is already utilized for this product, the existing product. So we need to reduce the manufacture of existing product in order to get this special offer. Right? So when we are reducing the manufacture of the existing product, we will lose a contribution of how much? 800 hours and into 10 rupee per hour. So when we are using 800 hours of 800 hours of labor towards the new order, we are losing a contribution of 10 rupees into 800 hours for the existing product. That is the opportunity cost. 8,000 rupees is the opportunity cost for getting the new order. So now what is now we have to find out what is the total cost. Total cost 9,000 rupees, we know. 9,000 rupees is the material cost that we need. Okay. Opportunity cost we have calculated, it is 8,000 rupees. So opportunity cost, direct material cost. Now what are the other two components? Labor and overheads. Okay. Labor, what is the per hour labor rate? 40 is for 4 hours. So per hour rate is 10 rupees. It can be directly taken from the question. Okay. For 4 hours of labor, 40 rupees. So for 1 hour of labor, 10 rupees is the labor cost. If you are taking 800 hours, 800 into 10, which is 8,000 rupees. Okay. So that is the direct material, direct labor. Then we have variable overheads. Variable overheads, 20 rupees is for 4 hours of labor. Okay. So for 1 hour of labor, it is 5 rupees. 5 into 800, which is 4,000. So here we are taking all the direct labor and variable overheads against the hourly basis. We need one base to calculate per hour rate. So it can be on the basis of units or hour. But here, what is the limiting factor? Limiting factor is hours, labor hours. So we are calculating based on labor hours. Okay, so we have calculated for 800 labor hours what will be the variable cost, what will be the labor cost, and the opportunity cost. Material cost is already given in the question. So what is the total cost of manufacturing this particular product? It is 29,000. So 29 minus 32, we get a profit of 3,000. So it is a good option to reduce production of the existing product and use the 800 hours towards the special offer, because over and above the opportunity cost, we are able to attain 3,000 rupees profit. Okay, this is the contribution that we would get if we continued with the existing production. We have added that also in the cost. So over and above the opportunity cost, we are able to get a profit of 3,000. So in this question, where generally we will go wrong is that we will forget calculating the opportunity cost. We'll not calculate the opportunity cost. We have these details. We'll take 800 hours of labor. Okay, 32 is the sale value, 9,000 direct material. For 800 hours of labor, we will take the labor cost. 40 by 4 hours, 10 rupee, 10 into 8,000. We'll take the labor and we'll take up the variable cost also. Okay, because these are simple things that we know. So we will directly take the cost as per marginal costing. We'll take up the material, labor, variable overheads, add it up, reduce it from the sale. There will be a very high profit. We'll get a profit of how much? We'll get a profit of 11,000 and we'll say it's a good option. You go ahead with the project. But do we actually get a profit of 11,000 in this project? We lose 8,000 in the existing project. So net we get a profit of only 3,000 by this additional manufacture. Okay. So that is this is the calculating opportunity cost is the main crux of the question. Next, we go to budgeting. So we'll see one question. Budgeting is very easy. Do concentrate on fixed and flexible budget, cash budget. So these things, please be very thorough on these budgeting aspects. So Vidyarupa School has a total of 200 students from 5 different sections and 40 students per section. Okay, so they have 40 students per section, and the school is planning a weekend picnic around the city, visiting places, amusement park. So private transport operator has offered to lease his buses, and the maximum capacity is 50 students and 2 additional seats for teachers. So this is our point that we have to note. Okay, 50 students, total is 200 students. Now they give additional data just to confuse you. They have mentioned something like 40 students per section. That's not required actually. We need 200 students, 50 students in one transport. 2 additional seats for teachers. And the teachers will be paid 100 rupees as allowance. Okay. The other cost per student, breakfast, tea, lunch, and entrance fees is given. And then rent, permit fees, all the other charges, all the other expenses. No cost will be incurred for the accompanying teachers except for 100 rupees. So only for teachers, only 100 rupees. For the students, we need to calculate breakfast, lunch, and tea, etc. separately. Now, prepare a flexible budget estimating a total cost at levels of 40 students, 80 students, 120, 160, and 200 students. Compare the average cost per student at all these levels. What will be your conclusions regarding the break-even level if the school proposes to collect 100 per student? So 3 questions are there. So first question is preparing a flexible budget. If 40 students are coming for the trip, what is the cost per student? If 80 students are coming, if 120 students are coming, 160, 200 students, what is the cost per student? Okay, so there is both variable as well as fixed cost. Breakfast, if 40 students are attending, it will be 10 rupees into 40. Okay, which is 400. Tea, it is 6 into 40. Lunch, 20 into 40. Entrance fee, 4 into 40. This is the variable costs part. Okay. The first part is your variable cost. So that will be per student. So if we are taking a budget of 40 students, we have to multiply with 40. If we are preparing a budget for 80 students, multiply it with 80. So like that, for different segments, we need to find out what is the total variable cost. Now, rent is 1300 per bus. In one bus, 50 students can be accommodated. So if 40 students are only going, we need only one bus. If 80 students are going, we will need two buses. If 120 students are going, then we will need three buses, right? 50 plus 50, 100. So balance 20 will go into the third bus. So we will need three buses. If 160 students are going, then again we will need one more bus, that is four buses. So like this, we need to calculate how many buses we will need. And with 200 students also, we'll need four buses only. So in 40, it is 1300. It is per 1300 into 1. It will be 1300 into 1. Okay. Here it will be 1300 into 2. 120, it will be 1300 into 3. And then 160 and 200, it will be 1300 into 4. Okay. So this is the rent. Next is permit. Special permit is 100 per bus. So same thing will apply. So it will be 100, then 200, 300, and then 400. Then we have entrance fee. Entrance fee for the planetarium is 500 rupees. It is fixed. So entrance fee is 500. Prices to students is 1500. That's also fixed. So price is 1500 for students. We have, these are, fixed cost that is incurred. No cost will be incurred other than the allowance cost, which is 100 per teacher. So 100 per teacher, meaning in the first we have only one vehicle. So two teachers will be there. So 100 into 2. In 80, we will have two vehicles. So four teachers. Okay. And then three vehicles. Three vehicles meaning 3 into 2 teacher each in one vehicle. And then 100. Then we have four buses, two teachers each into 100 per teacher. Okay. So this will be our allowances. Now we have identified our total cost. Okay. Now cost per student will be 5200 by 40 students are going. So if 80 students are going, it will be 8400 by 80. Okay. So like that for each of the segment. So we will get cost per student under each flexible budget. Your conclusion if regarding break even, if the school collects 100 per student. So if the school is collecting 100 per student, if they are able to bring in about 100 students or 120 at this stage, they will be able to earn a profit. So break even is somewhere between 80 students where the cost is 105 to 120 students where the cost is 97. Then we'll go to the next question. Manufacturing company concentrates its resources upon one single produce, which sells to the wholesale merchants at 6 per unit. Okay, output units is 70 and 80,000. Maximum limit is 1 lakh. Okay, there are different levels at which they are selling. They can sell 70,000, they can sell 80,000, they can sell 1 lakh also at 6 per unit. Variable overheads at each level is given. Variable selling overheads at each level is also given. Material cost is 2 per unit with quantity rebates of 10% and 15% on purchase above 80,000. So if we are manufacturing 80,000 units and if we need material of 80,000, then we will get a rebate of 10%. And then if it is 1 lakh, we will get 15% rebate. Average wages is also 1 per unit, and fixed overheads, variable overheads are given. To sell the entire output, the selling price reduces by 5% and 10% for the production of 80,000 and 1 lakh units. Additionally, overseas offer to purchase 10,000 units at 6 per unit. Now, create a table showing marginal cost and increase in the sale value at 3 different output levels. Prepare a statement analyzing the impact of the overseas offer. Assuming the price remain unchanged and 1 lakh 1 lakh output level is achieved. So we'll prepare for 70,000 units, 80,000 units, and 1 lakh. Okay. First, it will be, we'll just put in the format sale. Then variable cost. Variable cost, we will have direct material, direct labor, variable overheads. Then we will get contribution. Contribution minus fixed cost is our profit. Okay, first put the format ready. Now, variable overheads, we are having the details. So let us just fill in. Variable overheads is 45,000, 50,000, and 58,000. Okay, variable selling overheads also we are having. So let us factor in that as well. 12,000, 15,000, and 20,000. Okay. Then material cost is 2 per unit. So here for 70,000, it is into 2. At 80,000 level, you get a rebate of 10%. So 80,000, it will be into 2 into 90%. At 1 lakh level, you will get 15% discount. So 1 lakh into 2 into 85%. Okay, this will be the material cost. Then direct labor. Direct labor is 1 per unit. So it is fixed. So it is the same thing, 70, 80, and 1 lakh. Now, to sell the fixed cost, fixed overheads is 65,000 for production, 35,000 for selling. So that is also remaining the same. 35,000 plus 65,000. So if you keep the format, if you first write down the format, as you read the question, you can fill up the points. So you'll not miss out on anything. Okay. So fixed overheads we have calculated. And then to sell the output, there is a reduction of 5% and 10% in the price. Price per unit is 6 rupees. Okay. So for 70,000, we will be selling it at 6. But 80,000, we will be selling it at 6 rupees and a 10% discount. So 90% of 6. And at 1 lakh units, we will be selling it at 15% discount. So 85%. Okay, so now we have filled in all the data. So we can calculate what is the contribution and profit. Okay, so profit is highest when we are at 1 lakh. When we are manufacturing at full capacity, that is where we will have the highest profit. So that is our conclusion on this. Now prepare a statement analyzing the impact on net income if the overseas offer is accepted, assuming that the other prices remain unchanged and 1 lakh output level is attained. So maximum output level is 1 lakh. We have attained that 1 lakh output level. Okay. So there is opportunity cost involved. If we have to take up this offer of getting this particular overseas contract, we need to give up on the domestic production for 10,000 units. So additionally, an overseas offer to purchase 10,000 units at 6 per unit is received. Okay. So if we get the overseas offer, we are not going to give a discount. Sorry, the selling price discount is 5 and 10%. So 95 and we will have 90%. Okay, still the 1 lakh is the most profitable one. So what is the per unit contribution? Contribution per unit at 1 lakh level is contribution by sales into, contribution by number of units, contribution by number of units, because unit is the limiting factor. So we get a contribution of 1.92. Okay. Contribution per unit is 1.92. So here, what is the limiting factor? Limiting factor is the production quantity. We can produce only maximum 1 lakh. We are already producing maximum 1 lakh. Now, if we have to take up the overseas offer, we need to reduce the domestic production. So 1.92 is the contribution per unit. So for 10,000 units that we are giving away, it will be 1.92 into 10,000. 19,200 is the contribution or the opportunity lost. Okay. Now for the 10,000 units of overseas, we are getting a sale value of 10,000 into 6, which is 60,000. Okay, 60,000 is the sale value. What is the material? Direct material, direct labor, and variable overheads. It remains the same for 10,000 units. So material by then opportunity cost. Opportunity cost is 19,200. So what will be our profit? 60 minus 17,000, which is the material cost for 10,000 units, labor cost for 10,000 units, variable cost for 10,000 units, and then the opportunity cost. So it will give us an additional profit of 6,000 units. Profit or additional contribution of 6,000 units. Because 1 lakh fixed cost is already incurred. So we need not take in that 1 lakh fixed cost. So it gives us an additional profit of 6,000 units. So taking up the export option is also good for the company because it gives an additional profit of 6,000 units. Sorry, 6,000 rupees. Okay. So this is how the opportunity cost part needs to be checked. If we need to give up something, we need to see what is the cost or what is the contribution that is lost by giving up that particular item. And that will be the cost for the new project that is selected. That is the opportunity cost for the new project that is selected. Okay, still even after adding the opportunity cost, if we are able to attain a profit, then it is a viable decision.